and Jurasek, CPAs Consultants, CPA, Ryan Parshall. Hi, Ryan.
Hey, Bart. How are you today?
I'm good. Good to see you. You look less stressed now that the big tax season is over with.
Yeah, I mean, we keep busy all the time, but yeah, it's a little intense from time to time.
Yeah, it never stops.
Yeah, never stops.
Now, this big, beautiful bill, does this throw in a lot of complication to a CPA?
You know, to be honest with you, I'm very surprised on how uncomplicated it is.
Really?
Yeah, I mean, if you go back to 2017 to the Tax Cuts and Jobs Act, a lot of those provisions they put out there were just kind of temporary through 2025. What this does is makes a lot of that permanent, but it kind of enhances it as well. So there's some good things, some bad things that come along with it, but in my opinion, most of it's been for the good, especially for individual taxpayers, and they'll probably see that starting this year, and some of it gets phased in over the next 3 years as well.
I was looking at the summary that Brian Jurasek sent me last night. That was from the AICPA, the CPA industry, and a lot of it looks like very, very specific, very minute issues, mostly about business tax.
Well, you know, again, going back, a lot of the original 2017 TCJA stuff was business related. And so now a lot of that is permanent. Some great things that have been kind of brought back into place is the depreciation, bonus depreciation in the year you buy something, a table, some chairs, an asset of the business, that is set up and depreciated over a certain amount of years. Well, over the years, that bonus depreciation kind of got phased down and down, whereas in year one, you could write that off right away. You know, year two, less and less. Well, now what that did is it restored that back. In year one, you can take that 100% deduction right away.
I think a lot of people are confused because of the political selling of this bill. On one hand, the Republicans say it provides opportunity for people to make more money, hang on to more of their money, and eliminates waste, fraud, and abuse. On the other hand, the Democrats are saying, well, this is benefiting mostly the super rich. It's not one or the other, is it?
I don't think so. I mean, I think, a lot of actual middle class individuals are going to see a big difference on their tax returns this next year. Things such as the child tax credit, that's got bumped up somewhat. People that are 65 or older are getting an extra deduction. I don't know if that starts in 25 or 26, but it's a $6,000 deduction that's good for a few years. People that buy new vehicles, this is kind of a new thing, that new vehicles assembled in the U.S., you can write off the mortgage or the vehicle interest on that. Vehicle interest in the past on a loan was not deductible. No. Now it is. You can go both sides of the political spectrum. Like I said, I think that it's gonna, individuals in the middle class are gonna see some benefits on their tax return, but what's it do for the deficit? I don't know. I mean, our economic deficit, I have no idea. But yeah, I don't think it's necessarily benefiting big business or anything like that. I just think what I'm grateful for is that they got it done now and not in November. It gives us time to plan.
Yeah, because the tax package that had originally passed in 2017 would have expired, and then people would be up in the air.
Right, and there's over 100 tax pieces to this whole thing, so there's a lot out there, and we're barely just touching on it. Mm-hmm. There's things such as your HSA. Like if you have a health savings account, there's some easier ways to get into that now. There's all sorts of things. There's been some changes to charitable contributions. It's across the board.
Well, let's talk about some of those things that have been, I guess, people's talking points. The tax on tips. That's a big thing.
That is a big one. People now that report their tips can actually get a $25,000 deduction. if there is some income phase outs, if you're a high earning individual, you may not get full write-off of these. But yeah, $25,000 for the time being of taxable tips that are run through your paycheck would be a deduction on the tax return. There's some more guidance that's going to come along with that, but that's kind of the basic piece of that right now. Same thing with overtime. Individuals working overtime, $12,500 write-off for any overtime you work. Now, the caveat to that is, if your regular wage is $10 an hour, your overtime wage is $15 an hour, that $5 increase is really the write-off, up to $12,500. And again, that is subject to income phase-outs as well. So if you're a high-earning individual, you may not qualify.
All right, for kids, we've got a child tax credit increase and something new called the Trump account.
Trump account, yeah. So on these, they're kind of like they're an invest. I want to say like a interest earning savings account that supposedly, if you opt into one of these, the federal government's just going to give you $1,000 to put into that. It earns interest over the years, and when the child turns 18, they can pull that out. And there's some ways to make that tax-free over the years, but it is more of a tax incentive type plan that is being offered.
Sounds like a savings bond.
Yeah, it kind of is. But the nice thing is if you opt in, supposedly the feds are going to kick $1,000 at it for your child.
All right, seniors, the Social Security, is it or isn't not being touched?
As far as the
taxability?
From my understanding, it's still going to be taxed. You get up to, if you have other sources of income, the way it is right now, once you hit a certain threshold, that Social Security becomes taxable. Up to 85% of it max is taxable. But if you're below certain other thresholds, it isn't taxed. If I remember right, that number's around the $40,000 mark if you're married filing jointly, and it's not going to be taxable at the federal level.
State and local tax deduction.
That's a big one. So, and I'm happy to see this one. So people that itemize their deductions kind of got the shaft back, 8 years ago, because anything you pay for state and local tax, being income tax withholdings, property tax, the sales tax, any of that, is capped at $10,000 a year. Well, if you itemize your deductions, that ceiling has now raised to $40,000. So what happened when that $10,000 cap went into place, a lot of people stopped itemizing their deductions and just took the standard deduction. Now I believe we're going to see a lot more people itemizing their deductions again.
And a lot of people made that same decision when they changed the mortgage deduction limits. What does the new bill do relative to mortgages?
The mortgages aren't going to change too much. The reason some of that changed back then was due to high income housing. It kind of got phased out based on how expensive your house was, and then your mortgage interest kind of went down from there. To be honest, for as long as I've been doing this, I haven't seen it affect a lot of people. And from my understanding, things are going to stay relatively the same in that arena.
We saw a lot of people take out home equity loans when we did have low interest rates, and people's values increased. But there was some Wild West to the...
Oh, yeah.
Is there anything in the provisions that will encourage people to use home equity for projects?
So with home equity, that can be a kind of a sticky situation because a lot of people will take those out and use the home equity line for a boat, right? As it had stood before, the house actually had to be collateral for that home equity line. So it's going to be the same situation.
1099s, any changes on those?
Oh, yes. I'm happy about the 1099 change. Right now, if you're an independent contractor, a lawn guy going out to businesses, The business needs to send you a 1099 if you've paid them $600 or more. 2025 will remain the same, but starting in 2026, that threshold goes up to $2,000. So if you've paid anyone $2,000 or more, yes, you will still need to 1099 them for those types of services, but that's a big jump compared to the $600. So you'll see a lot less 1099 reporting that's going to need to be met.
Yeah, and that's very cumbersome for small businesses.
It is. It's gathering the data,
Yeah.
you know.
Nickel and diming.
Right.
Yeah. Charitable donations.
Charitable donations, the big change on that is that if you itemize your deductions, that goes into that bucket. Not all of them are now 100% deductible. You have a floor of 0.5%. So really, you know, if you throw in $1,000 for a charitable donation and you itemize your deductions, only 95.5% of that is going to be deductible.
It sounds to me like you need a CPA. And that really is. I mean, these are the kinds of things that you guys have the knowledge about and can help. And people should make decisions based on professional advice,
Right.
which you offer at WIllis and Jurasek. Well, thanks for the updates, and
Yeah.
I'm sure some good information, some good news for some of our viewers. And thanks for coming in today.
Yeah, thanks for having me. Appreciate it.
Our CPA here at JTV from WIllis and Jurasek CPAs and Consultants, CPA Ryan Parshall.